Good morning, everyone. My name is Josip Kosik, and welcome to Sharpening Your Trading Skills. Today is June 25th, right after the major surprise at the market, after it has rallied. My email address is right here in case you need to contact me. Um, we are not financial advisors. Please take a moment to read the disclaimers here, even if you need to stop them. We do not provide any trade suggestion or any financial advice. And let me show you where you can get in touch with me in case you want to follow up on anything that we do in this session. This is tradingwithufos.com. I usually post my notes. After this session, I will post my notes right here so you will have it accessible. And we are going to start by looking at the current market situation, and then we're gonna pre-plan the possible trades for the next week for educational purposes only. So we're gonna start first with the big picture, and big picture always involves looking at the S&P 500, which has a 500 of the Fortune companies, large caps. And as you can see, yesterday morning, the market has gapped up from basically 37.90 all the way to the 38.20. That's pretty decent 40-point gap. And it has run straight up. And when you look to the left, what it has really happened, it has filled this gap. So this gap that was in place, it got completely filled. The question becomes, is there going to be another gap fill, which is really right in this area above it? Now, what really is interesting now to point out that overall, we are now in an uptrend if we are looking at the 9-day exponential moving average. We've been down for a multiple sessions over the period of number of days. But what really is happening right now that we are actually having the first day up in terms of the mathematical calculation using the auto climate, which is a proprietary tool of the Tradactive or the top Tradactive option planner. So we can have another several sessions up, which means there is a possibility that we might go into this area to fill the gap. However, one of the things that I like to do right now is look at the monthly. So of course we looked at the daily. We observed that we have a gap up here that has taken place, and we have another gap above it. So we have a ability to fill one of these gaps. Of course, that $1 million question is which gap is going to get filled first? Is it going to be the gap to the downside, or is it going to be the gap to the upside? And that's why I want to look at the monthly first, so we entertain the both possibilities of these two scenarios. So good morning, Jeff. Good morning, Mark. I'm glad you are present here, and I will now look at the big picture, and then we're gonna use a strategy planner to pre-plan the trades that are going to be targeting both of these gaps. And of course, we're going to be using the out of the money spreads on both ends, right? So what I'm doing right now, I'm bringing up my monthly, and I want to tell you the one update does not change the trend. The one update does not mean the war is over. The battle has been won. We have lifted off the lows, but in terms of the monthly, and we still have a four more session in June before we are over, there's a high chance it's still gonna be in a bigger picture, lower low and a lower high. There's a very little possibility that between now and the end of the month, we're gonna actually go ahead and create bar like this, taking out the high of the previous month, meaning there's a very low possibility of that, unless all of a sudden there's a peace in Ukraine and all of our troubles are solved. But even in that case, if that's the miracle that happens for whatever reason, you need to objectively look at this from both points of view. This trend line that I have drawn all the way from the beginning of the COVID up to the present, if we look at it and we lift like that and we still don't close above it, then technically speaking, we're still in a downtrend. We're still in a downtrend. So just be aware of it. This one day surprise that cut the shorts completely unprepared um, means that we should be planning for maybe market revisiting. I like what you typed in, Joe. This is basically you're betting that the lower gap is going to get filled first and then later on the higher gap. And this is exactly what this session is going to be. I'm going to be bringing here agenda in a screen, so you would notice that I'm planning to teach you um, out of the money bull call spreads for the top gap. And honestly, I mean, if it's a $5 spread, right? If it's a $5 spread, I probably want to put in it like maybe $1.30 debit. And the reason why I like to put the $1.30 debit, because if I'm completely wrong, I just lose $1.35. But if I'm right and we gap up and go higher, that $5 spread can make me $3.70. So it's really good risk to reward ratio. By the same token, I want to teach you then bear put spreads, which is really a topic that, in my opinion, uh, all of you should know. And even if I have to turn this lesson into just a lesson day, I have no problem doing it, because bear put is a double bearish. There's no chance that you can be reversing this kind of situation, because you got to be wrong on the both puts in case the market goes up. With the bull put, you can still do something about it, but over here you're having the two puts and they're out of the money. And again, I'm going to use the same logic. I'm going to do the $5 and $5 spread on S&P. So this is all going to be the SPX. This is going to be on SPX 5 point wide. I'm not planning to risk more than $1.30. And again, if we hit that level, then I will wait. This is cash secure to settle in cash. So then $5 minus $1.30. If you make me $3.70, and I will not necessarily do that for a Monday. I will probably go for a Friday option. And it's very important for me to emphasize that, because when you look at right here, SPX or even SPY, if you want to paper trade this, you have a lot of choices that you're going to get. So we're going to be looking at June 30th, right? So that's what we're going to be looking. This is a quarterly, and we can also look at July 6th. But definitely, we will not be picking the 27, because what about if S&P has 1 day of digestion at this high level? It starts to create what I like to call the bull flag. Bull flag is something that market tends to do quite often. Let's see over here, for instance, this would be a called bull flag, and the reason why it's called a bull flag, and just change this in the yellow. So this would be a flagpole right here, if you can just imagine. Well, I didn't draw this well. Let me try to redraw this thing a little bit better. So this would be a kind of flagpole, and this whole area over here would be then considered the bull flag. So this thing was a bull flagging, and then that bull flag did nothing. It didn't become a bullish. We virtually retraced more than 100%. Because when you're looking right here, this would be basically 100% retracement, but we retrace more than 100%. So now you're creating the similar situation over here. And I say similar situation because what is really taking place that we have had several sessions that are nothing else. Again, I'm picking the wrong tool, but anyway, I'll do it with this one. Several session of the green, green, green. And if I actually even do the simplest thing that can possibly anybody do, just count how many green bars are here. So obviously here you have a 5, and over here what happened after the 5 green bars? You had a bar that was driving everybody nuts because it didn't do anything. It just kind of digested. And a lot of people don't understand why would that be the case. Well, think about it. If you're running up the hill, like a just simple metaphor, wouldn't you at one point, when you reach the top of the hill, take a breather and stop and kind of not continue higher? So in the light of the fact that we do have this gap that is staring us in the face right at this level, we need to be aware of the fact that we might actually have a nothing else but a little doji like this. Doji means indecision, which is pretty much what happened over here. When you look at it right here, we had a little 1-day breather, and that became a 2-day breather, and then it was a surprise. Everybody's expecting it's going to go lower, and then it took out the high over here, just enough to confuse everybody. And I don't know if you see here, but there's actually mini gap that has taken place between these two bars. We close at the high here, and we open all the way down here. I would not be surprised, and mark my words, to see that we actually gap down, but not as low as this. Not as low as this. Because you see over here, what happened? We close here at the high, and we negated that whole move up, and we actually open up virtually at the low of that particular session. And it was one of the weird days because it was simply from the moment we open lower, market has rallied all the way up and close. So don't be surprised over here if tomorrow is not tomorrow, Monday, it's no big day. But as I pointed out to you, by Friday or maybe by Thursday, either by the June 30th or the June 29th or even July 1st, something happens. Something happens. So having said that, I don't want to spend too much time on this. What I like to do next is very simple. Bring the strategy builder. And when I bring the strategy builder, I want to slow down here and not rush and actually walk you through it. So we type in SPX and we need to target the area. And a certain area that we need to target needs to be again based off whatever we are looking. So again, I'm going to switch this from the SPY to the SPX, and I'm going to just mark on the daily what are these levels of the extreme. So I will know exactly what level am I looking at. So for instance, in this case, and I'm going to use a blue to kind of make this obvious, and somehow the tools in me this morning are not on the same page, so I'm going to repeat this again. It's about 4,000. So to the top side, I'm going to be looking at the 4,000. But if we come down and fill this gap, let me just change this in the red. This gap is at a round number of the 3,800. So on the top side, I'm looking at the 4,000 as a possible target, which is way out of the money. And on the bottom side, I'm looking at the 380. So to make this more visual, I'm gonna bring up the agenda Word document here and spell it out. And I was just about to quote to you. One of you had emailed me and I said, like, a great lesson, Josip. I really like when you keep the Word document on the bottom, so I have a visual reference on the top. So to make this kind of clear, what we are doing here, we're looking at this 4,000 level as our possible target for the bull call. And I'm going to start with the bull call because I remember at one of the sessions, Jeff said to me, well, when it comes to the puts and a call, I actually, I feel more comfortable with the call. So let's work on an out of the money bull call for about 30 minutes. And in the last 15 minutes, I'm going to switch to the bear puts. So if that's okay with you, type in the chat. That you agree with me, and I'm going to proceed here making this as visual as I could. So I'm going to have a top target here. Top of the gap is 4,000 even, okay? And bottom of the gap is 3,800. Lowest point of the lower gap and current price. Currently, SPX is at 39.11. Okay, gap pull. Okay, so this would be in red because this would be the bear put target, and this would be a bull call target. So why do you need that information? Because when I bring the strategy planner right here, the first thing that is going to ask you, what's the ticker? Okay, the next thing that is asking me, what is the target price? So please do not proceed unless you tell the trade active option planner, what do you want this thing to do to you? So what you want this thing to do to you is to target the price, and you can even spell out targeting the date. But the one thing, and I'm going to change color here to red, that I do want you to know, I disclosed it at the beginning, I do not want to risk more than what? $500. Now be aware of it that this platform needs to have something default in it. And what it has as a default in it is $2,000. I don't want $2,000. I want to what? $500. So I'm going to change this. So start with the risk in mind. Now I'm willing to risk $500, right? Because the spread is 5, as I have pointed out to you. See this SPX spreads. If I go here, let's say June 30th, I can't get anything smaller than what? $5 spreads, because each of these spreads is a $5 spread. So if I choose this, that's a $5 spread. If I choose this for calls that are obviously out of the money, then they're $5 spreads. So I hope I'm not confusing anybody when I say this is where you need to start. So I know a lot of people are like, oh, I'm going to hit the target in this. How much money are you willing to risk? Is that kind of makes sense, Joe? Is that kind of makes sense, Mark? Be pleasantly surprised when things go in your direction, but then be realistic that before you start getting into target and everything else, the target day, that you're willing to risk X amount. So I'm putting here 4,000. I'm going to actually not put the target. I'm going to just ask this to calculate for me. So now it's calculating for me based on one more component that I need to alter, and I need to alter, and I'm going to make sure that this is in blue for all of you to see, not at the moneyness. I do not want to put too much money on it. What I want to actually point out to you, if you're tracking this on your platform, please do it at the same time. Hit this little arrow down and notice that it gives a choice out of the money and way out of the money. Josip, I'm not actually understanding what you're saying. Well, okay, let me break this down by bringing this thing again. So I'm going to actually enlarge this because in the moment, I'm going to use the whole enchilada. I mean, the whole space just to explain out of the money concept. So if I have a current price at 39.11, at the 39.11 for the bull call spread, and what I'm going to do now, I'm going to actually create again insert space for 3 different things. So you would follow me. At the money, the one that says out of the money, and one that we want is way out of the money, right? Way out of the money. What would this thing compose of? Well, if I know that the currently, or as of now, because the market is closed and it's a Saturday, SPX is sitting at 39.11. Okay, if I know that's the case, if I do know that's the case, then what I can do is simply this. I can buy to open 3910 call that is at the money by 1 point. And then I can go here and sell to open 3915, which obviously at that point is what? Out of the money. Hint, hint, hint. That is exactly what I don't want. I don't want this one. No way. No way that I want this one. That's not what I want. Well, then you can say, but if this price is still 391, and let me put this lower here so it kind of makes sense to you. If this is a 391, and instead of you buying 390.10, you decide to buy to open 390.15, and then what can you sell as a higher? Then you can sell as a higher 390.20 call. Well, you know what? That's still correct because it's out of the money and it's out of the money. But that's not what I want. The whole reason why I typed out the top of the gap is at what? 400. Because that is this, baby. Way, way, way out of the money. Way out of the money. So I'm planning to sell to open, $400 call, and then I'm going to be buying to open, which is the lower one. Does that make sense, guys? How much that thing is going to cost? Not much. It's not going to cost much. And that's why I want to use this strategy planner with that area. And I'm pointing out to you that actually they're spitting out the bull call spread examples here. Let me just do it quickly over here to show it to you. If I bring up here 14, that's not enough. I'm sorry. I need to do a little bit faster because I'm so aware of the time here. 370. Okay, so that's not high enough. We need to add more strike price. Let's add like 34. It's not 34. Okay, so let's say I'm buying the 395 and then selling the higher. So I'm buying and selling the higher one, right? So that's right there about the $1.30. This is exactly what I want. Okay, let me just take a snapshot of this. So I'm taking the snapshot of this vertical, and then I'm going to put in Trade Active Option Planner, this particular thing, and work. Okay, so it has exact strike prices that I'm talking about. 3995, and I picked the June 30th is my strike price, and 400 is my top, and my original intention was to go for what? $1.30, David. Well, yes, then how do you know that? What's the position delta of the spread? Excellent. It's going to be very low, but be aware of it. What I want to also point out to you that most likely, if I now tuck this away just temporarily, for that June 30th, expectation of the market move is at least $100 higher by that particular day. And how you figure that out? Well, you figure that out simply by adding at-the-money call to the price of the at-the-money put. So let's now do this on this one. So I'm going to tuck this away, and I'm going to repeat the steps in a moment. So I'm going to go to the option chain. And I'm going to select the option chain for June 30th. And I'm going to reduce the strike prices to one strike price. And I'm going to tuck away all these other ones that I don't need, because really I just need June 30th. So I think everybody's clear that I'm looking here at the June 30th. We are currently at 39.11. So when I look at the asking price, I'm gonna put it in blue. That's about $50. And over here, it's also on the put side. And let me change the puts to red. On the put sides, the asking price is also about the $50. I personally think that this is underpriced. Now, why would this be underpriced? For a simple reason: when the market goes up, volatility comes down. So the fact that we are contemplating that the lower gap is going to get filled is making us buying debits as a perfect strategy. Now, again, the market maker assumes, and I think this is a market maker assumption, that within a week, uh, S&P 500 is going to move only 100 points. I think that's wrong. I personally think that's wrong. They say, like, well, if you go all the way till the July, then they expect it's going to be closer to 200, 188. I think they're grossly underpricing this, and we're going to take advantage of that because we're going to actually load up on that. Joe, I'm going to answer your question in a moment, because what I'm going to do right now, I'm going to put this particular spread inside my spread, and all the delta is going to be calculated. So we are adding one more leg to it. We're picking up the June 30th. So we're giving ourselves basically 4 trading sessions by picking up the June 30th. So we're going to be selling to open the higher one, which is around number 4,000. And we're picking the one that is $5 below, which is then 3,995. And I'm going to click OK. And of course, this is going to calculate as of now. So the aggregate delta is very low over here. It says about two pennies. Now, be aware of it. This is not accurate. And I'm saying why it's not accurate, because the top leg, you shouldn't be counting. You should be only counting your commanding unit. Your commanding unit in this case is a 3995. Okay, let me just take a snapshot of this, because when I take a snapshot of this, I can break this down in pieces in a Word document and kind of just walk you through it and not confuse you. Okay, so I'm going to stop right here. I'm not going to be teaching today gamma that I did the other day, because this is a different lesson. Now the market is closed. And I'm actually focusing on out of the money bull call spread that is on the top of the gap by using the $5 option, $5 wide strike price option, aiming to spend about $1.30 as a debit. This right now, because of the spread, it's calculating as $1.40. So now going back to the point that Jeff was asking. Like, well, why is the delta only 1? Well, the delta is only 1 when you actually subtract the difference of the two. But we shouldn't be subtracting difference of the two. We should be aware of it, that what is my commanding unit versus auxiliary unit. Auxiliary unit is my target. There's no doubt about it, because the auxiliary unit right here on the top, right here, that is my target at 4,000 even, is where if the price hits, I'm going to be exiting the whole thing. And I'm not alone at that area. I mean, like, I'm gonna ask you, like, isn't this kind of poking your eyes in the terms of the activity? There's a 4 digits on the volume, and there's a 4 digits on open interest. Now, of course, you can make an argument, well, Josip, these 4,000 calls that are traded on Friday, 5,188 times, were closing order of this open interest that is at 8,376. And you're right, you could subtract that. But how about if you look this up on Monday when everything settles and this becomes a zero on Monday morning, and all of a sudden over here it reads something like 12,000. Joe, you're dead on. This is huge. So we're not the only one placing the bets at that level. I mean, like we can bring up the option value map, and we can look at it, and we can do all these things. But the fact that we already zoomed in on what we need to zoom in makes us realize that we're kind of conservative, just going for a $5 spread. Maybe we can pick the lower one at 3990. I don't like that, because now we're putting the what? More than $500 in it. We are then putting like almost $1,000. Like, and why do I say that? Because the difference of the spread, strike spread width, is what I'm calculating here, right? So I feel comfortable with this because I have emphasized the point here that, and I'm going to make this in a green, that I don't want to spend more than $1.30 on it. And as you can see over here, it was calculated $1.30, and over here it says it's due to the market being closed. You see how they make the spread quite wide. Over here is a 50 cents wide. Between the $14 and $14.50 is a 50 cents wide. Over here is just insane. Over here is $1.30. So this would absolutely make no sense to buy as a single unit. If you bought this as a single unit, you already lost $130, because you're paying $15 when you sell something that you bought for $16.30. So these SPX options, they were never meant to be bought as a single unit. And another reason why this spread is not 50 cents like this, over here everybody sees that the spread is a 50 cents wide, for a simple reason that you can subtract the 14.50 from 14. But over here, the reason why this spread is $1.60, because look at the liquidity. And I'm going to just stop here for a moment, and I want to ask you here, is there something poking your eyes? Yes, very good answer. Two things. You cannot subtract the volume of the positive 571 from the existing volume of the 133. Are you recognizing this? So think about it. If I just switch this to the real estate, just for the sake of the metaphor, open interest means houses that are listed at the multiple listing as available houses. And there's 133 houses that are listed for sale. And there's a 571 possible buyers right here. Are you recognizing this? 571. These 133 houses will be sold, but not all the buyers will be happy, and that's where the outbidding takes place, right? So let's continue what we need to do. So what I'm going to do right now, I'm going to copy the spread into the risk graph, and I'm going to point out to you here how little here we are risking. Are you recognizing this? We are risking from here to here only that amount of $1.30 or 40 cents. Right now, let's type what it says right there, 40 cents. But our possible gain over here, as you can see, is $360. I like this trade very much. I'm going to finish it with it, and I'm going to then get to the more complicated one, which is bear put side. Okay, I'm going to get to the bear put side. So let me just copy this, so we kind of have that information. So I'm going to zoom in here. I'm going to copy it. I'm going to put it back in this document. When I put it in this document and I copy it, we will have all the information that we need to put in this document later on, and you will have access to it at your leisure. So expect to see this here, and it's going to have a bull call spread. I'm going to give you strike prices. I'm not sure if I'm going to do it within this hour or a little bit later, but basically 360. And again, what's the worst possible thing? You lose $140. But you don't expect this to happen on Monday. You expect this to happen between the now and the June 30th. Okay, so give you a little bit of breather time. But what about if you're wrong? What about if it goes down? Then we need to do the what? Bear put. And what is going to be my target? 380. Okay? So if that's going to be my target, let me just float this and start now with the new one. And what do I mean by a new one? I'm going to now build a new strategy targeting the lower one. Targeting the lower one. So what do we do now? We are again starting with the what? 500 is my willingness to risk. We are picking 3,800 even. Target date, we can type in 06302020. Somehow I didn't go through. Okay, and we're going to click OK. And it's loading up the bear call spreads. It's loading up the bear call spreads. It says the 3 results. You know what? Let's do this manually. So I'm going here to June. I'm still not seeing enough down here, so I'm going to ask for the 38. That's still not enough. I'm asking for, let's say, 44. Okay, so we're going to be buying 3805 and then selling the exactly 3800. Bingo. Wow, only 90 cents. This is even better than what I expected. That means we can probably then make $410 on this particular spread. Okay, I'm kind of losing it here. Okay, slow down. We'll walk through it. This is now our bear put spread. And what is a bear put spread? Just like I have built this explaining, I'm going to be doing same way, explaining way out of the money. Okay, so we're currently sitting at 39.11. I'm buying 3805 put that is way out of the money and selling even the lower one. And why? Because the chart is actually pointing out to me, and let's bring up the S&P on a daily, that we can go down, revisit this. Okay, so if we are anticipating that we are going to revisit this area in the near future, then hitting this 3800 is not that unrealistic, because it's only about $111 lower, and that was pretty much what is called market makers expected move. What do you mean by that? Market makers expected move is a calculated right here on the platform. Of course, plus minus. It doesn't need to be exactly 111. It can be around 100 points, which for me it's absurd, because take a look. What did S&P do on Friday? It rallied $116. So could this be achieved within the next 5 trading sessions? Yeah, I would say overachieved. So it's very realistic to expect that. So what are we going to do now? We're going to go into option chain. Instead of the long call, we're going to be selecting the bearish, and this particular strategy called bear put spread. So when I click it up, what it's going to do, it's going to create for the nearest expiration. But I know that the nearest expiration is monthly, so I know I need to edit that. So I'm going to right away click under the edit, and I'm going to edit this to what we want, which is June 30th. So when I edit one, both of them get edited. So we are selling the 38 even, and then just $5 higher, we're going to be focusing at the 38.05. So 38.05 is what we are buying. Now be aware of it. When I upload these things, I might actually look at the open interest and volume first, because I want your eyes to be trained to look at this, and be aware of it. We shouldn't be doing this unless institutions are also doing it. Now, I know there's a lot of information there, and I find when I zoom in here and cut out just the most essential one, including delta, then things becomes way more comprehensible for every one of you. So, one more time. My long put at 3,805 gives me a right to sell. My short put is a double negative, which means obligation to buy at 3,800. That's mean the maximum value of this put if the price of the S&P drops, and now I'm saying now it's a June 30th close, and SPX is at, and I'm not going to put this number, I'm going to put something like a 799. Think about it. Did this price action pierce to 3,800? If it did, it also pierced to the 3,805. So then how much is 3,805 having the value? You would say then 3,000 are wrong. 3,805 has in a moneyness of what? $6. How do we get the $6? That's how we got the $6. But what about my sold to open 3800? That has at a moneyness of $1. How do you get that? Well, I got that simply by subtracting these two numbers. So it's like 6 minus 5. Okay, so I get that stuff. So this is now $5. Actually, I should bring this up because I don't like to hide anything. I want all of you to see. So as the spread, the profit is $5. Yeah, but that's not true because we need to subtract the what? Cost of 90 cents. Therefore, what's our maximum profit? $4.10. So here's a moment. Joe, Mark, and whoever is here, but it's not typing anything in. Do you like the call side better? That it's giving you $360 rate of return. I mean, $360 profit on outlay of the capital of the 140. Or do you like this one that gives you this kind of rate of return? And I'm going to take a picture here for all of you to see. Which one do you prefer? Let's say you have a limited amount of capital and you say, well, obviously I can't do both of them. I can do only one of them. Which one do I pick? Oops. Well, I thought I snapshotted. If I didn't hear that click, like a camera click, then I need to repeat this. Yeah, Mark says, I like the lower one better. Well, I like the lower one better, but I have a revolutionary idea that I can propose here in a moment as soon as I hear the click here when I take a snapshot. When that camera makes that click sound, then I know the computer has obeyed my instruction. Yeah, it's over here. So I'm going to just dump it in here so you will see it. So basically, I don't know why this thing changed to 80 cents when it was supposed to be 90. It doesn't matter, but you still see the profit potential is better on the one side than on another side. That's the bottom line. Oh, I see why it is. Okay, because the Thinkorswim is quoting a little bit different than this. So if I stick to this one, are you recognizing this? Here it says you're earning 400 and let me just make sure, $420. And let me make this into green. $420. Because you're risking, and let me change this now in red, $80, and here's the $80. Okay? And again, let's take a moment here and evaluate for all the practical purposes, be aware of it, that I only have 20% chance of probability of this happening. 20. That means there's an 80% chance that this out of the money is going to be out of the money. So here's my thesis. We have like 15 minutes before the session is over. Here's my thesis. So when I was preparing for this lesson, this is what I was thinking. So I start saying here to you, agenda for today is to do the out of the money on the top side, correct? And to do also out of the money on the put side. Now that we have done all this work together, and we know that on the top side, I was correct with the $1.30 credit. I should put plus minus. In reality, it was like $1.40, if I'm not mistaken. This is what it's saying, that this particular trade is $1.40. Are you following me on this? Okay. This one, in reality, was actually 80 cents. For a bear, in reality, is 80 cents. 80 cents. So here's my thesis. Do them both. Because if you add these two together, what are you risking then? One of them is going to hit. So when one of them hits, that one that hit, it's going to be $5 in the money. From that, you need to subtract the cost of what? Both of them. So when you subtract the cost of both of them, what's the most that you can earn on one of these two things? 280. Now, of course, do you need to do both of them? No, you don't. But what about if you pick the wrong one? What was it? You're like, I'm so sure it's a bear put, and then it actually hits the bull call. And then you're kicking yourself, saying like, I should have done both of them because what's the worst possible scenario? That I pony up $140 to the top side and $80 to the bottom side. And if the one on the bottom side that I'm really hoping and I'm believing, due to everything that's going on over the weekend, market must go down, and all of a sudden Russia and Ukraine sat at the table and they agreed to have a ceasefire. And market interprets that as a positive news and gaps up on Tuesday or whatever, Wednesday, Thursday, whatever. Then that bull call will be hit 4,000. It would be completely in the money. Bell would ring, everything would settle in cash, and there would be $500 of the profit from which you would need to subtract $140 investment for the bull call and $80 that was wasted on a bear put. But could there be a possibility that this happens? June 30th comes and price is at $379. You would be smiling all the way to the bank. But then did you make $410 here? No, you didn't, because you wasted on the top what? $140. $140. So question for you, Joe. Question for you, Mark. Does this make sense, what I'm talking about? Yeah, Monday morning could be built off, which should then determine which strategy to use. Yes, I agree with that, Joe. And that's why I love these sessions on a Saturday, because on Saturday, emotions are taken out of it. You're looking at this objectively. We started by looking at the big picture. We started looking at the big picture. I'm gonna just minimize this for a second and just go back to the SPY on a monthly, because I'm not here on a SPY on a monthly. I'm objectively looking at this and saying to myself, this is still downtrend. I mean, no matter what you're wanting to see here and hoping to see, this is still the trend. If you're connecting these highs that are lower highs, only if we, as I have drawn with the green tool, break above it, then it would be back to the uptrend. But as of now, this 1 day move that we had here, I don't want to say it's nothing. It's like it's in a war. a major battle has been won. Okay, but what is really interesting, I don't know, was there a really big volume that was being traded? Were there really that many? I mean, if I switch this to the hour, like take a look at, on the hourly what happened. Most of this gap you couldn't trade. And the reason why I'm saying that most of the gap you couldn't trade, because it was like what is called gap and go. The price has simply gapped up and remained sideways for virtually 5 out of the 6.5 hours. 5 out of the 6.5 hours. So this is the first half an hour, and then you have 5 hours of nothingness. And then in the last hour, we took out this high, which honestly, I was looking at the market live and I was very surprised. I mean, who in the right mind would be buying this going into the weekend? Well, somebody who has inside information, and we don't want to mention any names who does that. But we have gone higher. We have gone higher. So when you switch this back to the daily, it appears as one big gigantic move. I'm trying to go back in history to show you some of the things here that might kind of help you to understand. Over here, there were multiple gaps that were left unfilled on the way up. Multiple gaps, multiple gaps. And because I don't have a certainty, neither do you, I would prefer if we fire up both of these trades at the same time. The name for this trade is long iron condor. Rather than being short, it's actually long. So, what do you mean by that? Well, this is what I mean. I bring up my bull call spread and I edit. And now I'm adding an option leg and I'm adding an option leg. Remember, this is a call side. This right here, it's going to be a put side. So I'm going to be now switching this to 3,800 for my target. 3,800 for my put. And this is going to be 3,805 for my long put. So now when I hit it, be aware of it. I'm buying the lower strike price and selling the higher one. On the put side, I'm buying the closer to the current price and selling even lower one. So when I click now OK, it gets calculated, and you see, as long as we stay in between this level and the 4,000, right? I'm at loss. But if we hit the 4,000 level, I'm then at the maximum gain. Or if we pass the 3,800, then I'm at a higher level. If you want this, I can take a snapshot of this, and in fact, maybe that's the one that I should be putting inside that worksheet. Just 1 second. We still have 4 minutes left. I can do this quickly here. So just give me 1 second. I want to be efficient here, so I'm going to be talking about the long IC. Long IC. 1 second. I'm going to read your comments here in a moment, but I want to make sure that I can do this. So would you have a better put on yesterday? Basically, you have a strangle that you have to pay for with the short units. Joe, could you rephrase that question one more time? Because I think there's a two-parted question here. Monday morning could be a big open, which would then determine which strategy to use. Yes, that's true. So would this have a better put on yesterday? Basically, you have a strangle, but you have to pay for it. Which yeah, correct. You can look at the long iron condor as a strangle that you help with short units. I agree with this. Um, uh, Yes, but you know what? When the market was closing, I was too focused on doing something else rather than coming up with this plan. Once when the bell rang and I looked at the bigger picture, daily, weekly, monthly, I came up with this plan. So I think as of now, this is the strategy that I'm going to be posting in my live session notes. This long iron condor, I won't be separating them. I will be actually just posting this because I like this risk reward. I really like it a lot. I like this. In fact, what I can do right now, just before we close the session, I can show you how this is execution will look on a thinkorswim. Okay, so I'm opening up the June right here. We said we're gonna do this one, right? 30805 is the one that I'm buying. Control click buy, says a vertical. Okay, so there's that 90 cents. Then I tuck this away and I scroll it all the way to the other side. And here's my 3995. So now I'm again clicking here buy and click the vertical, and I'm holding the control key as I'm doing this. So now it loads up both of them. Okay. Um, on my thread active, it was saying to me that I can profit $280, but I'm risking only 220. And I think that's accurate because this is what the current price is. And how do we came up with this? If you take a moment here to read the notes, um, we're buying bullish side for $1.40. We're buying bearish side for 80. That brings up the total out of the pocket cost of 220. But because over here the market says this, I will retype this to match 220. This is how I would start. Let's say Monday morning comes. I put my bet out there and I back up. Just like in real estate, it doesn't matter that other guy wants to sell the house for $1 million or whatever the amount is. Let's say $310,000. You're giving them low ball offer at 220. What's the worst thing that can happen? 2 minutes later, you need to reprice it. So here it is. Now it says, look, well, this thing can make you maximum profit of this. You know what? Just send it in with the GTC and see what it's going to be. So let's now go ahead, edit this, go to Cancer, fire it in. And what's the worst thing that can happen? The worst thing that can happen that you don't get filled. That you don't get filled. So then what do? Single right click, cancel and replace, jack it up to 225, 230. Once when you get to 250, stop and think about it, because at that point your 250 can only make a 250, because one of these two things is going to be wrong. You don't know if the call side is going to be wrong. You don't know if the put side is going to be wrong. But one of these sides are going to be wrong. One of these sides, because think about it. All that we are trying to do here on the S&P 500, shoot for one of these gaps. Shoot for one of these gaps. And whether one gap gets filled and another gap gets filled, it's almost like it doesn't matter. You want profit. Whether that profit is from the call side and the put side, that's almost irrelevant. That's almost irrelevant. So anyway, I'm going to stop recording right here. I'm going to be probably posting this in maybe a few hours from now because I have an appointment that I need to run to. But I do want to end with this picture. If you can just kind of keep in mind this picture. There's a gap right here that we're shooting at, and in blue, there's a gap right here that is shooting at. most likely market maker, and the big institutions are going to fill this gap that is least expected. Which one is the least expected doesn't matter for me. I'm completely unbiased. I'm targeting 4,000, as I have pointed out to you, to the top side, and I'm targeting 380 to the downside, and not for Monday, as I mentioned. Not for Monday. I have targeted this for end of the week, Thursday to be exact. So I'm gonna include this later on when I come back from my appointment, and you're gonna have this visual right here. So we're aiming for either 4,000 or 3880. So having said that, I'm gonna end the session right here. Thank you very much. I hope to stay in touch with you over the next several sessions, and stay hedged, and bye. Thank you for attending the session.